All right. So this is Paul Hopkins here, Director of Acquisitions at CPI Capital. And today I got Brian Bingham here with me, who is our cost segregation expert. And I've engaged Brian to help us with the cost segregation on Atlas at Bay Point. I figured it was a good time for us to dive a little bit into what is cost segregation and how does it benefit the investors. So I'm going to hand it over to Brian, and he's going to
Sure.
go through basically the initial proposal that we have for this property and explain a hypothetical situation for an investor investing $100,000 into the deal. So, Brian, welcome. I appreciate you
Thank
joining
you.
us today.
Appreciate it. Absolutely. Let me
Yeah,
get it pulled up. How's it looking on your side?
looks great. Thank you.
All right, beautiful. All right, guys. So Brian Bingham. I work with Madison Specs, which stands for Specialized Property Engineering and Cost Segregation. Say that three times fast.
No
But
doubt.
the key is we only do one thing, and we do it very well, and that's cost segregation or accelerated depreciation. And if you're not super familiar with the term accelerated depreciation, essentially it's buying a commercial property or an income producing property and taking a tax loss benefit on the physical property. Physical property meaning the windows, walls, roof, furniture, appliances, everything that's physically there that's not dirt. That's what you're able to take in losses just by buying or investing in the property. So for this property in particular, I was running some numbers for you guys, and they actually look really good. This is a very, very good property for, in my terms, a tax benefit side of it. So, I'll just give you some quick overview of the numbers, and then I'll break it down for you on a per investor level. So right now, you guys are purchasing this property for $16.85 million, and you're buying at the end of June. So the way we operate when it comes to taxes, overall is it's not per day, it's not per month, it's per calendar year. So when you're buying this property at the end of June, it's not saying anything, but you still have a full month of July, August, September, October, so on and so forth, plus 2 days in June that you're able to take in depreciation. So we
Perfect.
calculate everything all the way down to the date the property was purchased. So this one is considered a residential property. There are two types of depreciation, methods. One is non-residential, which is things like self-storage, retail, things that, you can't live in essentially. And
Right.
that depreciates over a course of 39 years. This being residential depreciates over 27 and a half years. Now, why that's so beneficial to know is you are taking the purchase price of 16.85 million. You take land value out of the equation. That's why there's so many protests and tax talks about land values going up and down. You actually cannot depreciate land. So we have to take that number that the land is appraised for. I do air quotes because you can fight it all day long.
Mhm.
And take that out of the equation. That leaves you with a depreciable basis. So the basis here is 16.85 million minus about 15% land value. So that leaves us with a basis of $14,322,500. That number right there is how much tax depreciation you will get for this property total over the next 27 and a half years.
Got it.
You with me so far?
I got it. Yep.
All right, beautiful. So from that number right there, that 14 million plus, we're going to reclassify all the assets on the property, every single thing of it, from the foundation to the roof and everything in between. And the way we do that is an engineering method. Think of it as a sort of detailed appraisal after purchase, not before. So whenever you guys purchase this property, that amount that you paid for it you're able to break out what is physically on the property and how much life expectancy and cost is associated to it. So essentially, we did a quick projection based on online research, database, methods, everything you can think of without physically visiting the property for the estimate and projections. And we were able to come up with, of that 14 million plus, we were able to separate about 31% into different life expectancy methods under 15 years.
Got it. Okay.
So there's essentially three different property asset class types. First one is 5-year property. And those are things like, I always call them your interiors, carpeting, appliances, cabinetry, floorboards, ceiling fans, decorative lighting.
Okay.
These are things that the IRS classifies as a life expectancy of 5 years or less.
Got it.
So you put them in a 5-year category.
Okay.
The next one is 15-year, which is considered exterior land improvements. And these are things that's added to the land, but not necessarily part of the structure of the building. Things like pool, fencing, driveways, sidewalks, dog parks, tennis courts, everything of that nature that's added to the land, but is technically not part of the living structure.
Got it.
All right. And we were able to find around 9 to 10% of the total basis you're able to put into that category.
Okay.
The rest of it, and which is usually typical for multifamily properties, we found about 70% is structural related or 27.5-year property.
Okay.
Those are things like roof, windows, plumbing, electrical, drywall, foundation, things that make the structure of the building, but not necessarily curb appeal, if that makes sense.
Sure. So where does
All right.
air conditioning and hot water heaters fit within this?
So basically, hot water heaters and air conditioning, they are mandatory nowadays. So they are considered 27.5-year property.
Okay.
But getting really, really far into the details, there are some HVAC units, boilers, chillers, there are some roofs, there are some everything that you can, put into its own classification as whether it's energy efficient or new improvements or whatever that would fall into a 5 or 15-year category. But right now, for value add properties, they're typically in the 20s, the long term, the 27.5-year property.
Okay.
So the reason why we separate all these out in a cost segregation study is because right now your basis, remember that basis of 14 plus million,
Right.
you're basically straight line depreciation. You're taking that 14 million and dividing it by 27.5.
Mm-hmm.
Now that 27.5, I mean, that's a lot. You're still talking about a lot of money, but when it's all broken down, that's a per year for the next 27.5 years.
Right.
Then it's broken down per investor ownership percentage.
Right.
So after that, you're looking at very little. You wouldn't be able to actually offset the income you're generating from this to offset the tax side of it. You will have to pay income taxes by doing a straight line depreciation method on this property.
Okay.
Nobody wants that. So the idea with it is when you do cost segregation, by reclassifying and putting the properties where their correct life expectancy is, you're able to accelerate the depreciation that you're going to get for the next 28 years. But instead of waiting 28 years for it, you're going to get it the first 5 to 6 years,
Amazing.
1 through 6.
Amazing.
So, I mean, it's the same depreciation. You're getting the same amount, but you're just getting it now instead of later, which is very nice. So from here, I'm going to go to the next one. Is that still okay to read?
Yep, it is.
All right. So there's 3 different types of depreciation you can do on a multifamily property. The first one is this right here, the total, straight line depreciation. This category right here, this is what I was talking about. You take that basis of 14 million, divide it by 27.5, you're getting the same exact amount, about 520,000, per year for the next 28 years.
Okay.
Multiply that by your ownership percentage, it doesn't mean squat.
Okay.
It's not going to help you. So we're going to do cost segregation. That's the very next, that's a step up. Cost segregation, we're reclassifying all the 5, 15, and 27 and a half year assets inside that amount.
Mm-hmm.
And we're moving it to where they're supposed to be, years 1 through 5 for 5-year property, years 1 through 15 for 15, and years 1 through 27 and a half. So by sectioning it out like that, you are essentially doubling year 1, which you would have gotten. And that's the reason why it's double year 1, but triple year 2 is because of when the property was placed in a service. You're buying
Mm-hmm.
this the end of June, so this is half a year,
Yeah.
essentially, half a year's
Right.
work. Then the next year is a full year, and
Got
so
it.
on and so forth. It breaks it down all the way. So
Got it.
instead of getting 282,000 year 1, you're getting 582,000. Instead of getting 500,000 year 2, you're getting 1.5 million. So
Wow.
that's kind of how it breaks down for cost seg. You're simply reclassifying and moving the assets where they're supposed to be.
Okay.
Now, the next one is more fun. Sorry, guys. I try to make taxes fun because they're
Hey,
fun
that's
to
all
me.
right. Yeah, my whole job is to make numbers exciting, and that's hard to do. So,
Oh yeah,
hey, I'm getting excited just listening to you talk about this too. So this
yes,
is great.
sir. All right, so the next one is bonus depreciation. That is the biggest one, biggest key factor right now. And
Okay.
that's cost segregation on steroids. What you're basically doing is in 2017, Trump administration put in the Tax Cuts and Jobs Act. And
Hmm.
in the Tax Cuts and Jobs Act, it basically said that any commercial property placed in the service during a certain year is eligible for bonus depreciation. And what that means is you're taking anything under a 20-year life, 20-year life or less, which is 5 and 15-year property,
Hmm.
you're able to move into year 1, all of it
Amazing.
into year 1. Now, the key to this one is in 2024 is the dates for bonus depreciation to get 100% of those was from 2017 until 2022.
Yep.
And then it dropped 20% in 2023. So it
Hmm.
was only a max of 80% you were able to take year 1. Now we're in 2024. It's a max of 60% year 1.
Hmm.
It's not saying that you can only take 60 and that 40% that's left goes into the win. That's basically saying that the 40% difference is going to be rolled into the next few years.
Makes sense.
You're
Okay.
still getting it. You're just getting 60% max. Now, for all you people that follow the government and politics and whatnot, they've actually have there was a bill that was placed down to the House of Ways and Means to restart 100% bonus for the next
Right.
few years.
Right.
It passed through the House immediately. Then it went to the Senate and sat there. And then the
Hmm.
Senate went on vacation for 2 weeks.
Hmm.
Everybody thought it was when they came back, it was going to be accepted. Now there's so much stuff on top of it. There's talks that it might not actually be restarted until June or July,
Okay.
but now there's talks it might not even be done until the end of November,
Mm.
when after the election.
Sure.
With that being said, regardless, if it does restart, it only benefits you as investors on this deal because right now you're getting a massive amount on 60%. But just imagine if that does pass, you're already sitting there with 60, you're going to get an additional 40% on top of that
Hmm.
just for investing in this.
Mm.
So it only goes up from there.
Amazing. Yeah.
All right. So from bonus depreciation, what we're doing is, year 1, I'm going to go back to the first one. Year 1, 2024, you are going to get either 282,000 for straight line, 582,000 on cost seg, but on bonus depreciation, you're getting 2.9, almost $3 million year
Wow.
1.
Yeah.
And then it drops down to 834, then 662, and so on and so forth. So the key to this is you're going to be getting a massive amount of depreciation or losses to offset all of the income for this property that you will be receiving.
Mm.
Now I'm going to break it down more. Are we good on the whole property?
Yeah, I think so. I think that makes a lot of sense.
All right, beautiful. How about, can you see my spreadsheet?
I can, yeah.
All right, excellent. All right, guys, this is essentially just like an investor depreciation breakdown worksheet. Nothing fancy about it. I didn't reinvent the wheel. These are just a spreadsheet with formulas in place to help better investors understand it.
Okay.
I actually made this spreadsheet because I wanted to invest in a multifamily property a few years back, and it kind of blown up. Everybody loves it.
Yeah.
So the idea is from left to right, we're going to do, $16.85 million purchase price, 15% land value, which gives us our basis of 14.322 million.
Hmm.
Now, on the split percentages, you have to take that into account based on, the method of your investment and the general partners to passive investor split percentages. So that's
Yep.
just a percentage factor calculation. The raise amount on this property is $10.5 million. Raise meaning that's the amount needed from you investors to purchase this property.
Correct.
And we're going to do it on just a flat $100,000. You can invest a lot more if you want. If you want more tax benefits, you just invest a lot more, period.
Sure. Yep.
So the cost segregation, if you remember that pie chart at the beginning, this 31% is the 5 and 15 year percentage combined.
Got it. Okay.
All right. So from there, what all these means is it's basically calculating on a $100,000 investment, you are going to have a 0.95% ownership of the entity that's buying the property.
Hmm.
All right. Now from that's how we're able to break down your tax benefits.
Hmm.
So with $100,000 investment all broken down, you're going to receive about $19,000 to $20,000 of depreciation for 2024 taxes.
Yeah. And
With
that's
that
sim
meaning,
and that's simply an offset to their standard income, correct?
absolutely. So the idea is, think so this is at an 8% pref, right?
Correct.
All right, so 8% pref, $100,000, 8% pref, you would get an $8,000 payday, right, for the year.
Hmm.
So you now show that you made zero income from this property because you have a $19,000 loss already given to you just for your investment.
Right.
And now take 8,000 off of that. That means you have 11,000 plus left to roll over into 2025.
Amazing. Yeah.
Yeah, it doesn't go away. It just rolls over. And I love putting icing on the cake. And see this amount right here, this $2,500, 2,563.59.
Yep. Yep.
That is actually added on top of what you're rolling over in 2025.
Okay.
So let's just do a quick, flat rate. Let's say you're getting, this is 20,000 even. $20,000 you're getting for just your investment in this property in losses.
Yep.
You get your full $8,000 on the pref side. So that lowers your tax depreciation roll over to 2025. You're only able to roll over 12,000. But then you add 2,500 on top of that. So now you're starting 2025 with $14,500 in depreciation losses.
Right.
What that's saying is if you do an entire year, you get another $8,000 pref, you already have the losses to offset that income. So again, you don't pay taxes on the income you made from this property.
Amazing.
Yep. Now we roll over again, let's say 2026. We're still doing it. We're still doing the 8% pref. The key is, are you going to have enough on there? Let's say now you take 8,000 off of 14.5. So now you're sitting there at, okay, we're at about 6,000. Do you
Right.
get 8,000 of income? Now, here's the cool part about this. You guys, in the last 2 years, you've added improvements and renovations into this property, right?
That's right. That's right.
Any of those that you're adding, any improvements, any renovations, those are added assets to this property. When you do cost seg at the beginning for the acquisition,
Yep.
you're taking everything as it sits based on that purchase price. Now,
Sure.
what was your projection on the improvements?
About 1.6 million.
Okay. So you put 1.6 million, let's say over 2 years, right? 1.6 million into this property. That's additional depreciation that you're going to be able to take. And
Mm,
it's usually much higher than the acquisition,
sure.
because most of those are for
The
upgrading units,
They're in the
adding
5 year
to.
and the 15-year category.
Exactly. So
Yeah.
that's usually upwards. I've seen as high as 80%. I've seen as low as usually 40%. I
Okay.
mean, it's crazy. So let's, meet in the middle. Let's say 50% of that 1.6. So you're again refilling the buckets for all of your investors on their depreciation. So now again, they're sitting at 6,000 and 20. What are we at? 2026?
Mhm.
6,000. Now you're going to add an additional, I think if you break it down, you're adding an additional 4,000. So now again, 2026, again, you're offsetting all that income. So without trying to be too corny about it, this is tax-free investing in its glory.
Yeah.
I mean,
Yeah.
you're
Makes a lot
you're
of sense.
investing your money in this, you're generating your money immediately, year over year over year. You're not paying taxes on it. You should, but you're not,
Yeah.
because legally you have the losses to offset the income.
Wow.
So it's a beautiful concept. This is a great property, guys. Like I've seen my fair share in the last. I've been doing this for 10 years. I've seen my fair share. This is a very good property, and I have very high expectations that it's going to be much higher on a percentage wise on my end. So you're probably going to get a lot more than that.
Awesome. And so when we close on the property, the next steps that with Madison Specs, you come out to the property, you do your own physical inspections and survey, and you counting the
Yep.
number of windows and doors and putting that into basically your master spreadsheet and coming up with more of a fine-tuned number at the end. Is that about cover the basis?
That's absolutely right. I mean, from start to finish, we got you this estimate,
Yep.
broke it down per investor for you based on, whenever we do this breakdown, it's always based on lending terms. We have to make sure we have that right on the money. And then once you close on the property, then we do everything from start to finish. We have an engineer go to the property physically, almost just like an appraiser, but a
Hmm.
little bit more detail.
Yeah.
They count absolutely everything, take their photographs, put it into an IRS approved cost segregation study report.
Okay.
Now, from there, we give the reports to the general partners. General partners then calculate everything and put it into K1s. Those K1s are distributed out to the investors. K1s
Yep.
will have how much in returns, as well as the massive losses they're going to get for 2024.
Yep.
Yep.
Amazing. Okay.
That's it. I mean, for me, it sounds simple. I know it's kind of complicated. Nobody wants to talk about taxes. I usually get whenever I get up on stage, I have an audience full of sleepies.
Yeah,
So,
yeah.
but I love the simplicity of numbers don't lie, calculations. It all comes down to, like, how can we, you know, not pay taxes legally, while
Hmm.
also not giving the IRS an extra tip.
Yep,
This
yep,
is the way to do that.
yeah,
Invest in commercial real estate, get those losses, offset that income, sit back in your yacht, Lamborghini, whatever you want, tax free.
yeah, absolutely. So
Yep.
what then happens upon sale? So say we sell this property in year 4, year 5. The depreciation that was expected to come for those following years. Explain like the next steps on the capital gain side of things and the depreciation.
Yeah, absolutely. So I actually usually break quite a few myths when I talk about the end of term on the
Okay,
sale.
okay,
So whenever you go to sell a property, there's basically two big things. There's the capital gains hit, which is taxable, and there's the depreciation recapture.
okay.
Depreciation recapture essentially is taking whatever the basis that is left. So the basis meaning, remember I was telling you the depreciation is calculated to the basis.
Hmm.
So, when we started at, what was it, 16.885 million?
Correct. Yep.
Let's say, I'm just flat numbers. Let's say $6,850,000 of depreciation you guys have taken over the last few years of ownership.
Okay.
So that leaves us with a $10 million basis. If you sell the property for $20 million, all right,
Mhm.
$20 million, that means your gains is going to be hit on the $10 million difference, which
Mhm.
I know it's a lot, but on the recapture side, there's all these ceilings and caps in place that on the recapture of depreciation, you pay back a maximum of 25%.
Mhm.
It's based on ordinary income tax rates, and that's where the key is. And this is where a lot of people are like, I never thought about that. Because it's based on ordinary income tax rates and it's capped at 25%, if you have high net worth investor or you are a high net worth investor, let's say
Mhm.
you're in the 35% tax bracket, you're not going to pay 35%. You're going to pay a max of 25%. If you are in the 22nd percent tax bracket, you pay a max of 22%.
Got it.
So it's based on that. So the key to this is how do I lower my income tax bracket? Now, a lot of the multi-property investors, you have not just this property, but maybe a couple of others you've invested in.
Mhm.
All of the losses from there, you're able to apply to your overall adjusted gross income
Mhm.
filing your taxes. So what if it drops you down into the 15% tax bracket, all those losses? Well, now when you go to sell this property, you'll pay a max of 15%.
Yep. Yep.
So that becomes the key. It's all about how do I work the percentages to my favor, and
Sure.
that's by investing over and over and over into real estate.
Yep. Makes a lot of sense. And
Yes,
so, as a
sir.
disclaimer, this is only for US based investors or US entities.
Yes.
Unfortunately, it doesn't work this way for Canadians, correct?
It's more complicated.
Yeah. Yeah.
It's there. I mean, the Canadian tax laws are a little bit different, especially when investing in a U.S. real estate. I would say talk to your CPA, talk to your accountant, make sure
Yep.
because there could be a upside, but there could be a downside. But I'm not the one to tell you directly.
Yep, absolutely. And we have a great tax attorney in Canada that we could refer our clients to if they have any more specific questions on how the depreciation works in Canada, how this may benefit them or not. But yeah, this is all great information, Brian.
Yep.
And I appreciate you breaking this down
Pleasure.
for us. This is taking a complicated situation, as you said. Taxes sometimes could be confusing. It's meant to be confusing.
Oh,
Um,
absolutely.
and you've broken it down into very simple concepts for us.
Oh,
So
for
I
sure.
really
And if
appreciate that.
anybody at all, anybody wants me to go over this on maybe their individual investment with this
Yep.
property,
Yeah,
I'm available anytime you need me. Like
absolutely.
I love doing this. This is one of my favorite things in the world.
Yep.
And I'm happy to break it down for everybody. Talk about your strategy, talk about your investing journey, especially on this property. I very, very highly recommend it.
Perfect. Do you have contact information that you could share with everybody right now?
Oh, sure. I wasn't planning on that one. Let
That's
me
all
see
right. I'll
what I
put you on
got
the
here.
spot.
All right. Let me
And you could
see.
always reach out to me at CPI to get Brian's information or have any other questions that might be related to this, and we could put you in touch with Brian. But I'll let
For sure.
him share his contact
I was
info.
gonna say, I don't even know where I can put my email signature, I guess.
Yeah, you pull up whatever you feel is appropriate. But
Okay.
yeah,
Here we go. I was just random one. There you
fair
go.
enough.
There's my contact info.
All right, excellent. So
No,
Brian
it's
with
yeah.
Madison Specs.
Yeah, be big ham at madisonspecs.com and call me. You get my cell, you can text me. 214-983-0862 is my direct line. It also goes to my cell if I'm out doing a tour of some kind or speaking on stage. I go to about 20 or 30 conferences a year and speak at half of them.
Nice,
So
amazing. So we'll see you around.
absolutely.
All right,
Yeah.
Brian.
Again, I one of my favorite things is just educating as best I can for everybody. It's not about screwing the government. It's about working with everything they put in place for us.
Yeah, that's right. Yeah, they write the codes so that it helps the infrastructure of America, basically, right? So,
Exactly.
where do we put our investment dollars? It's to help with the infrastructure, and they give us cost or benefits
All right.
on supporting those causes. So, yeah, real estate
Perfect.
is just one of those. Excellent. All right, thank you, Brian.
All right. Thank you. Appreciate it.